Good afternoon. My name is Adishan Naidoo, and I am coming to you live from the trading desk with Tom Gale, Executive Global Market, Standard Bank. This is the Market Pulse. Tom, good morning or good afternoon.
Hello, Adi, and the audience.
Well, Tom, I'm going to be out of action for a while, but my colleague will be taking over the Market Pulse. So, for the audience, I'd like to introduce Palesa Moyaba. Pale, good morning or good afternoon.
Hi, good afternoon. Good afternoon, Mr. Gale. Good afternoon, Adi. Nice to be here.
So it's going to be a different pulse as to normal, Mr. Gale. It's going to be slightly more robust in terms of there's going to be questions from myself and Palesa, but there's a lot going on. There's a lot of turbulence at the moment. I know it's a bit old at the moment, but you were actually at the mining in Davos, so there's going to be a lot of news from there. Hopefully, you can share insights from. What can you bring the audience today, Tom? And how can you
Yeah.
help us this week?
Right. Well, look, now that we've established that it is the afternoon, we've got one thing straight. The rest of it we're going to have to try and figure out as we go. As usual, we don't have a crystal ball, but we do have a little bit of
90% right.
Yeah, but we do have a little. We're privileged enough to have some insight from our position as the largest trading business in South Africa, the largest bank across the African continent, and as you say, we're pulling a little bit of insight and feedback from Cape Town's mining indaba from last week. Yes.
Well, that's awesome. I mean, that's a great slide there. I see some familiar face, but if you could just for the audience, for the benefit, give them a little bit of an insight of who that face is and why the slide's so important.
That's right. So it's common knowledge now that the chair of the Federal Reserve, Jerome Powell, his term ends in May, and despite the 3 or 4 horse race, we finally heard from President Trump that the nomination to replace Chair Powell is Wash, and I think we've covered this actually in to a large extent, Adi, you and I, in previous sessions of the Pulse. He had been seen at some point in the past as a hawk. We think that's slightly misinformed. He certainly has quite astute views when it comes to running down the Fed balance sheets, holding of US debt, of US treasuries, but he should nonetheless be cutting rates. I think where his face brings us in here is really a sort of a wider debate, which is around US jobs and US prices, and what it has been shaping up as a great US rate cut debate. The chart in the middle, the graphic in the middle, shows the direction of US jobs. So jobs have been being added up until recently when US payrolls went negative. But then last week's US payrolls print was a surprise on the upside. The US economy added more jobs than we'd expected. The graphic on the right nonetheless shows US prices, which have been moderating, and as of Friday, we had a fairly soft US consumer price index print. And so the net result was that we had some choppiness in markets last week. The graphic I'm sharing here on the right is short US yield, so 2-year yield. The yield on the 2-year spiked midweek on that strong payrolls print, and then came off again on a soft CPI inflation print for the US. So if you and your audience have had trouble trying to figure out markets, you're not alone. It is really the market, widely speaking. I just want to just focus your attention on the graphic on the left, which is showing how many rate cuts for the US are currently priced, and I've underlined in yellow the December 2026 Fed Fund future. And without getting into too much detail here, I think the takeaway is that there are 60 basis points, 0.6% of rate cuts priced now. Post that at the moment, post that soft inflation print. So markets are sighing a little bit of relief, and we're certainly in a slightly more constructive place today than we were middle of last week.
Okay. So I mean that's good news for markets. But I mean, to your point, I mean when the actual news came out and we actually had, you're actually correct, a kind of an emergency pulse just to kind of understand it. I mean, our local market, in terms of, I know we're talking about markets across here, but our local market took quite a bit of a knock on that news. So it's good to know that there are some rate cuts that are being priced. You know, there's some market softness that we can see, and I mean you kind of mentioned it in the previous pulse that, you know, there still is quite of a bullish run. So it is good overall picture. It's not all doom and gloom.
No, of course. I'm not sure the audience would be familiar with an emergency pulse unless it was, the previous week. I
Yeah,
think just
yeah.
just to regroup here. So we have had a little bit of choppiness in markets. Why should markets be so fixated on whether the US is cutting twice or three times this year? 25 basis points at a go. If we're going to get two or three, should we really be that concerned? Well, the answer is yes, we should, for a couple of reasons. First of all, the US being so big and so important. But secondly, Adi and Palesa, we have also started. We've had markets globally have started to get used to the idea that the cutting cycle for a lot of major economies is over, and within that grouping, I'd mention, for example, Australia. So Australia recently hiked interest rates, yes,
Yeah.
hiked. And Reserve Bank of New Zealand this week may also hike. We've certainly had to get used to Japan hiking. They've got a fairly idiosyncratic set of circumstances right now, but hiking they are nonetheless. And the ECB has almost certainly finished cutting, even if they're not ready to hike yet. So, rate cuts are good news for markets. Typically, they create slightly looser financial conditions. Once you're looking at the end of the cutting cycle, and once you're actually hiking rates, then markets do tend to be a bit on edge. So, markets particularly focused on what the Fed is doing, and markets will want to see that the Fed is delivering at least two cuts, and probably the third, to be comfortable. And the charts I'm sharing here, guys, on the left, I have given you the gold price in blue, which is flirting with $5,000 an ounce. It's been the wrong side of it this morning. It's just back on side. The line in white are those December 2026 Fed Fund futures, and I've inverted it to show the higher the white line goes, the more rate cuts we're getting. So you can see that US rate cut expectations does play a significant role in where gold is going.
Okay.
And just Mr. Gale, in terms of the guys that are cutting rates in the respective regions, what is the rationale? What would be the rationale as a retail investor and just looking in? What's the rationale behind cutting when the whole world is in a cutting cycle? And what would be the rationale around increasing the rates?
Yeah, so increasing rates normally happens when inflation is ticking higher or showing signs that it's a bit sticky. Rate cuts is typically where inflation allows central banks, and different central banks have different mandates, but inflation allows central banks to cut in favor of creating jobs. Now, the US is a good example of a dual mandate central bank. And they're caught between this idea that, first of all, inflation, as measured by either consumer price index or personal consumption and expenditure, is running above the Fed's target, the target being 2%. But on the other hand, as we showed and as we explained on a chart a couple of charts back, is that the US has been adding fewer jobs up until the most recent print, partly perhaps because of the productivity gains from artificial intelligence, but also partly because there's this so-called K-shaped economy in the US, whereby the bottom half of the US is really struggling, lower income earners and so on, squeezed on a cost of living. But rest of the world certainly has done a lot more cutting than the US. The US had been holding back last year because of tariff uncertainty. Okay, now these are good questions, but we've got to be careful we don't disappear down too many rabbit holes here. And I think that if we bring it back to South Africa, where we are expecting at least 2 rate cuts this year, maybe more. We think we deserve more. Nonetheless, the fortunes of the rand are very closely entwined with precious metals, because precious metals and sales of those precious metals, gold and platinum group metals, allow us to bring in dollars, sell those dollars and buy rands. So it's an important export receipt. So we want to know that gold's going to hold up, and we want to know that platinum is going to hold up. And the chart on the right here is a chart of the platinum price, which keeps fading. The momentum certainly is in platinum is causing us a little bit of concern. We do typically see 2,000, just below $2,000 an ounce bought. And part of the feedback that we got at the Mining Indaba in Cape Town last week was very constructive for platinum. So for now, our base case remains that we are upbeat on the outlook for gold, and we are constructive also on the outlook for platinum and platinum group metals. I won't go into too much of the reasons why, but one of the things that struck us at Indaba is that there's probably less recycling available. So metal scrap, platinum and so on, which typically sits in second-hand used catalytic converters as one source. There's less of that overhang than we figured there might be if platinum prices rise. And the other piece of this is that it takes a long time also to bring mining supply of platinum online, and we didn't get the impression that there's a lot of mining supply that can be turned on into these higher prices. So as long as the demand side of the equation for platinum is upbeat, and we think it is good demand for combustion engines from China, for example, we think that the outlook for platinum remains constructive. So right now we're taking the positives, the pluses, and although we might argue that we're unlikely to get back to the highs for platinum, $2,500, $2,700 an ounce, we nevertheless will hold in this band here, which is something like $1,800 to $2,200 an ounce, and that'll continue to be a nice tailwind for South Africa. I'm going to come on to what it means for the JSE and the rally for the JSE in just a moment. There was a buzz at the Mining Indaba for sure, which you'd expect given where precious metals prices are, but it wasn't everywhere that we picked up the positives. And if there's another theme that comes from that we took away from the Indaba, it is that there is a shortage, a difficulty sourcing electricity to start new mines, and those mines are big consumers, of course, of energy to get them running. Those mines typically South Africa, but Southern Africa too, and all the way up into the DRC. And there is certainly a need for good, reliable sources of electricity, which will come in time. Will come with deregulation across the electricity sector, across the southern African geographies. But certainly at the same time too, if you're mining coal and if you're mining iron ore where the prices have been less than spectacular, you are taking a little bit of pain. You're taking a bit of a pain because your dollars are worth less and your costs are in rand. And it's certainly topical that Eskom is charging high prices against international benchmarks to some of the smelters and the furnaces here in South Africa. We heard last week, for example, from South 32 that it would be closing its Mosul smelter because it's unable to afford the high costs of electricity. So it hasn't been all good news, and I do think that the Reserve Bank will be listening, should be listening when it considers that these enormous gains that the rand's had over the last 12 months is causing a little bit of a pain for some of these exporters and these dollar earners. I think with that in mind, we might expect that we'll get more than the 2 rate cuts that are currently priced for South Africa.
And do you think there'll be light at the end of the tunnel for these mining companies, of course, that are complaining about the high prices of Eskom at the moment. Do you think Eskom would maybe make policy changes around how electricity is priced, etc.?
Well, yes, Eskom is in the process of unwinding its vertical monopoly. This has been in the works for some time. We know we're adapted to the idea here in South Africa that things take time, of course. But there is a key milestone on the horizon where that is concerned. It will be the launch of the South African wholesale electricity market in April, and that's the first real milestone that opens up for a more competitive electricity market. Now, there'll be a phased approach to the deregulation, which will probably take 5 years right the way through to 2031. So this won't be a quick win, and it certainly won't come in time for operations like Mosul. But in time, Palesa, yes, we should in time see the benefits of a more competitive electricity market. And there's certainly no shortage of independent power producers looking to come online and sell into a competitive electricity market, and at the same time buyers looking also to benefit from a more competitive electricity market.
Well, thanks for that color, Tom. And I'm just thinking about how I mean the mining sector has faced a lot of challenges in the past years, Transnet being one of the parastatals that were creating the challenges. Do you think we are feeling some positives coming from the Operation Vulindlela coming out of the Indaba?
Yes, well, for sure, that's absolutely right. From Indaba itself, and then you know I think an achievement celebrated at State of the Nation too. It is certainly the case that the reforms being driven from within the presidency are having a positive effect. And it's not new news. It's not new news that Transnet is on a slow road to recovery. We're seeing some green shoots of Transnet rail freight improving from very low levels. You know, we've got a long way to go, I will grant you, but certainly we are starting to head in the right direction. And as long as we have a reform-minded government, and as I think investors would be keen to see that the Government of National Unity continues in its current form and makes more business-friendly concessions, that this will continue to carry the country forward and improve growth as we go. Palesa, I'm going to just get to you know, my last couple of slides here. First of all, is the JSE rally intact? I think we all need to acknowledge that a lot of the gains for the JSE have been thanks to the miners, the platinum group metal miners and the gold miners. In fact, the chart on the left shows just index, so percentage gains over the last year or so. The blue line is our mining sector, and the white line is our top 40. So percentage gains. You can see that a lot of the work has been done by the metal miners, and if metal prices do fall, then the JSE, of course, is vulnerable. It's not our base case, but I think we need to acknowledge that 17% of the weight of the top 40 is in the gold miners, and something like 34% is in the mining sector more broadly. So you know, there's quite a concentration of risk. On the right here, I've shared a couple of charts of some of our retailers up against the all share. So the orange line, for example, is the Truworth share price, TFG Foschini Group in blue, and Woolworths in purple. Just to be clear, sorry, these are also normalized performances. And so the retailers, the apparel retailers, have lagged the index, and we often get questions as to when the turn for the retailers. Well, there's a lot of value in these retailers, and if you're patient and you're brave, you know, these three, for example, we are very constructive on. They offer you a lot of value, but if they were to turn and the miners were to sell off, nevertheless the JSE rally would be somewhat it would be somewhat constrained. this brings us to final slide or two, and positioning some product for you, Palesa and Adi, and your audience. I think Adi will want to just add a little bit of an intro here for some of our structured product. If we speak to one of these a week, I'll talk you through the Quantum Plus in just a moment, but it is for those of you out there who are a little more conservative and perhaps a little more cautious on your outlook for the JSE over the next few years.
Yeah, well, you're 100% right there, Tom. And I mean, we've covered a few of these products. When I say products, I mean structured products. They offer capital protection. We've had the gold auto call, which we spoke about a couple of pulses ago. I'd say last year sometime. We've had the AI that we covered as well. So there's bespoke structured products that are available to online share trading customers and auto share investment customers that sit within our platform. But as you're 100% right, there are top 40 or these 4 or 5 structures that happen monthly that allow clients to basically take advantage of where previously these structured notes were, or these structured products were 100,000 minimums. We've dropped them to 25,000. So minimums have become moved in line with our bespokes, and actually they're just not well, I'd say, given enough airtime so that clients actually know that given what's happening in markets, there's so much turbulence, you want to invest in products that actually protect your capital. And these are great little instruments to put in your portfolio. So it'll actually be nice if you could, as I say, explain one of them. And I see you picked the Quantum Plus for this week. So that's a great one to start. If you can just give the audience some color.
Yeah, sure. So as you say, we'll tackle one of these at a time, just because otherwise it's information overload. The Quantum Plus SA is a product designed to offer you a tidy coupon at the end of year 1, but you're going to tie up half of your capital for 5 years. So just to explain that a little better, you'll invest your 25,000 Rand minimum. You will be in line at the end of the first year to be paid a 16% coupon, and you'll have 50% of your capital returned at the end of year 1. Okay, so far so good. Sounds pretty good. The remainder of the capital, the other 50%, however, stays invested in the top 40 and will remain locked up until the end of year 5. And in that meantime, you will be getting the performance, 50% of the performance of the top 40. That is your payoff profile. So once again, if you take a more cautious and conservative view on the outlook for the local market, the top 40 over the next 5 years or so, then this really does front load some coupon, front load payment, and you really need to be happy with the idea that the return for the top 40 thereafter is not enormous, and you'd be willing to accept just a 50% payoff profile for the rest of that time.
Well, that's quite a great little product, because to your point, I mean, let's work on the 25,000. If we invest 25, you're saying at the end of year 1, the client basically gets 14,500 back. They're 12.5 plus 16%, so that's 2,000 Rand for argument's sake. As I said, we're working on the minimum value here, and the other 12.5 is invested for 5 years, and they get 50% of what the return is. So if the JSE does a 40% return, they're getting 20. Correct me if I'm wrong.
Yes, that's right, Adi. That's it in a nutshell right there.
So that's brilliant. I mean, given what's happening in markets, this is perfect for someone who's a little bit doesn't have a great risk appetite and wants to kind of be a little bit more cautious on the approach and wants to protect the capital. But what's lovely about this is, unlike the bespokes where you put 25,000 and it's locked up for 3 years or 5 years or an auto call, etc., here actually after a year you can actually get some of your cash back. So if you want to reinvest in something else or you need capital, you're actually not canceling your term and actually going through a structured note where you're going to pay penalties for canceling early. It's great because after 12 months you get some capital back and then you're still protected for 5 years. So it's quite a nice product that you chose first time.
Yeah, and let's just reiterate that point. Your capital is protected, so it's full capital protection over the life of the product. I would urge you and your audience to call in to the contact centres or email the contact centres. The details are on this slide here. It's very important that you fully understand what you're doing before, of course, you commit.
Perfect. Thanks, Tom. And as you're right, I mean, on these instruments, they actually are on online share trading. So as a client, when you log in on your home screen, before you actually do anything, under special announcements, these products are there, each one wrapped up individually, where you can click on it, view the full brochure. You just obviously showed a slide shot there of the term sheet, but the full brochure, the terms and conditions, and it actually is there for you to apply online. So thanks so much, Tom, for that. And I see you've come to the end. So unless there's anything Palesa you'd like to add, I say Pali for short, but anything you'd like to add, Mr. Gale, this has been brilliant. Palesa?
Well, that's been a great market pulse as always. Thank you, Mr. Tom. And Adi, see you on the flip side.
Perfect. Thank you so much,
Thanks,
Tom.
everyone.
Thanks, everyone.